Crypto trading for beginners. If you are looking to get started investing in crypto, trading crypto, putting real money at stake and trying to gain wealth in this industry, we'll go through all of the major aspects of investing in crypto. They're all listed as timestamps down below, and there are many other links, helpful pages, and other videos that I'm going to reference. Everything will be listed down there so you can further your education. We'll get started firstly though with why trade crypto and actually how to do that. So there's really two main ways that people can trade crypto. The first one is investing, buying the assets and holding them and waiting for that long-term growth to occur. It's actually a really good strategy because crypto is outperforming every other major asset class, and I'll show you the data around this in this video. The other way, and you'll see this a lot, is trading futures or derivatives. So you can see the difference here. Now I'm going to show you on Bybit mostly. I mostly use Bybit and Binance. I'll leave links below to the crypto exchanges I use if you are new on there. They give deposit and trading bonuses. So obviously a good start if you are signing up to those. I'll leave the links down there. You can check all of the details. However, we can essentially on every different exchange trade the same stuff. So spot trading. This is where you use your money to convert into a cryptocurrency. You hold it for that growth. Now with derivatives, this is much more for day trading, short-term trading. And what you're actually doing here is trading a contract that mirrors the price of the underlying asset. Why? Well, this is really for short-term trading and speculating on the price. Now, if you own a lot of cryptocurrency, you can actually use derivatives to hedge your positions, which is take risk off the table, try and actually sell your positions forward and things like that. Too much for a beginner's guide, but I have full derivatives and futures trading guides linked down in the description. We're going to focus on trading in the spot market. Now, whether you use Bybit, Binance, OKX, Coinbase, it's all going to be pretty much the same in terms of how to do this. So it doesn't matter if you don't use Bybit or not. Or Binance, but we'll go through that in this video. Which exchanges should you use? Just use the top exchanges. There's no need to use mediocre or lower level exchanges because they're all pretty much the same in what they give you. The assets are the same. So Binance number one, OKX, Bybit here, Coinbase or Kraken if you're in the US. When investing in any asset class, crypto is one of them, what we need to figure out is what is the natural rate of growth of this asset class? Because people are looking to trade. What you're looking to do is make money or increase your wealth, right? And so we can actually look at all of the different asset classes and what they return us. A great way to do that is just simply to look at the returns of those asset classes over time. Now, I'll show you all of that data in this video. So what we can do is go to Glassnode Studio. This is free. Glassnode is paid, but this is part of the free version. And so I'll link this specific web page down in the description. This is known as the CAGR, or the compound annual growth rate, and they do it for Bitcoin and Ethereum. Bitcoin's CAGR, which is just kind of the base, thing that we need to know, right? We need to know if we just buy Bitcoin every week, how much are we going to make each year? So the orange line is that CAGR. As Bitcoin is growing and maturing as an asset, the returns that it's going to give are going to come down as more people invest in it and push the price up and it gets more mature. In any case, you can see the orange line here. Bitcoin is making a yearly return of around 50 to 60%. Call it something like that. So for right now, if you just bought Bitcoin once a week for the last 4 years, each of those years, you're making 60% on your money. That's important because it gives us a baseline as to what to expect. So if we're just doing that, nothing else, not being professional traders or, sitting at our computer 15 hours a day, just literally smash buying once a week, we're making 50 to 60% a year. That's the baseline on what we should expect for any other strategy that we take. If we're investing in altcoins, which are smaller and therefore more risky, then they should actually give us higher returns than that. If they don't, then they're obviously a bad investment. So that's the baseline that we're looking at, is 50 to 60% returns each year, just with a simple dollar cost averaging strategy, buying once a week. They also do this for Ethereum. Ethereum is averaging around 80 to 90% a year for the last 4 years. So this is all of the, ultimate bull market highs, bear market lows, all of the emotion around that. If you just literally set up a weekly buy into these two assets, you're making 80% a year on Ethereum, 50 to 60% a year on BTC. Now, these growth rates may not continue, of course, as well, because there are sizes that these assets can get to, right? Maybe Bitcoin being genuine crypto asset, maybe could have a bigger market cap overall over the very long term than something like a platform like Ethereum. That's getting a bit more complex for a beginner's guide. But just to have in our mind, 50 to 60% a year, just with this simple strategy, taking money, putting it into BTC instead of maybe the stock market or something like that, you're already outperforming most other investors. And so every strategy that we take has to have this return as a baseline. Those CAGR figures for Bitcoin and Ethereum are against US dollars. US dollars are really the reference rate for cryptocurrency. Every price that you see quoted is against the US dollar. So if you don't live in the States, then there are actually options to trade against your local fiat currency as well. Now, if you are looking to invest in crypto and keep the money in there and trade around, most people will actually trade back into stable coins, US dollar stable coins. A stable coin is a stable coin issuer takes dollars, puts it in a bank, and so they have dollar assets there, and they issue the stable coin on the blockchain 1-for-1. So it should have a 1-for-1 value with the dollar. And that's what really people trade against if they're trading in and out within crypto. Fiat currency pairs do exist, but they're not as liquid, and everything's going to trade against US dollar stablecoins, especially altcoins. They won't have fiat currency trading pairs. So it's up to the individual. If you're in a country where you have liabilities in that currency, you may just want to take that fiat currency, put it into the assets and invest in them, and that's it. And then eventually you sell them back out into the fiat currency. But the stable coin is really the linchpin for liquidity. So whatever you're trading, it's going to have a stable coin trading pair. So the two major ones, USDT, USDC. USDT is offshore out of America. USDC is kind of onshore in America. Both reputable and been around a long time, but every single trading pair will be against US dollar tether. So that's what you can eventually trade in and out of a lot of the time. Of course, you have to take that stable coin and trade it back into your local fiat currency if you want to withdraw it out to your bank or pay any liabilities in your local currency, right? So as you can see here, USDT, USDC trading pairs. And on Bybit, you can see Euro trading pairs as well, right? So you can actually deposit, get Euros there, just switch the Euro directly in. So that's the easier way to actually invest in. If you want to trade around a lot more often, you're going to find that stable coins are a much better way to do that. If you go over to Binance, go to the fiat currency trading pairs here, you have Turkish lira, euros, Brazilian reals, Argentine peso, a few others right here, right? So you can see the trading pairs are very slim. There aren't many. So really, if you are trading around actively, it really is in and out of stable coins that is going to be the best way to do that. But of course, the exchange that you're using will have some fiat currency trading pairs as well. So you can actually withdraw that fiat currency from the exchange. Next, we'll look at Bitcoin versus altcoins, and as a beginner, how you should actually approach this. So even though I think Bitcoin is the apex asset, it's unique, it's different to everything else, I do also recognize that there are other options as well. Smart contract chains, clearly have some sort of demand, and we can potentially make money from trading those as well. So there's two things to look at. The first one is long-term and then short-term. So long-term, if we are investing over longer periods, right? So at least 10 years or more, we're looking at, which assets are going to have the highest potential value, because those things eventually will outperform everything else, right? As everything else is a lot smaller in its scope, it may top out faster, right? And so something that's much bigger in its scope that can really, be successful over much longer periods is going to eventually outperform, right? So something like Bitcoin, which could potentially be this unique world money asset, could potentially have a much higher market cap, right, in the tens of trillions, versus something smaller like a smart contract platform, which is, a competitive platform with many other competitors. If Bitcoin is unique, it's going to have the highest market cap, the highest value. If you're investing over very long periods, that's obviously something that's going to be attractive. Now, over shorter timeframes, of course, growth rates for smaller things can be faster. So altcoins, or these smart contract chains or other types of coins, can outperform BTC during particular cycles or short periods, of course. So there are opportunities. So we just have to be aware of that and figure out what mix of that we actually want to get invested in, right? So firstly, market cap's important. Market cap right here is the total value of the coin. Market cap is derived by taking the price per coin right here and multiplying it by the amount of coins in existence, so you get the actual total value of the thing. That's the thing to focus on, not the price. So things that are smaller can move in percentage terms much more over shorter time frames. But what are you doing? Are you investing, or are you trying to trade those shorter time frames? You can do both at the same time. You can do one or the other. It's up to the individual. That's important. So make that decision. Are you an investor? I think that we should all create a portfolio first that we have, right? Those savings. So we invest in those assets that are going to be large and reliable over the very long term. Then we can take a portion of that and we can trade cycles. We can trade smaller things if we want, as, either fun or speculation, or trying to, earn excess returns over and above what we're getting from our investment portfolio. But if you don't have the investment portfolio first, then you're in a kind of weak position, because you're always trying to gamble and speculate on prices, and you don't have that solid, reliable base there that is just growing with the market. So I would always suggest investment first. That's the majority of the percent of what you're doing. And then trading smaller things or shorter term cycles, we can do that with a smaller portion. Putting all of our money into that trading side, I think, is foolhardy, but it's everyone's, up to trade exactly how they want. So looking at cycles, we can see a clear trend here is that altcoins tend to grow in price and market cap towards the end of each Bitcoin cycle. These cycles, which I'll go through in a second, are about 4 years in length. That's because of the Bitcoin cycle a little bit, but it's also because of macroeconomics, central bank cycles, interest rate cycles, business cycles, all of that stuff seems to match up in 4-year periods where you get an expansion and a contraction. These are about 4 years in length. If we assume that that's going to continue more or less, what we see is that you get the big expansion and then you get a bear market, big expansion and a bear market. Altcoins tend to outperform in the latter stage of a bull market in terms of their market share, and then they underperform and come off in the bear market. Important to know, I'll link this down in the description as well. We need to time trades if we're trading to make sure that we are looking forward all of the time. Most beginners will get in during a bull market when prices are high because they want to make money. And so they're nervous and they're anxious and they're far too fast. So they're beginners, they don't have that professional long-term kind of knowledge. We have to take advantage of what's going to be happening in 12 to 18 months time always if you're trading. So a trade would be 12 to 18 months. Looking forward, we can see these 4-year cycles. So how to play that? First one is, during a bear market, you can take a lot more risk because prices are way lower. So prices really are the price for taking risk. During bear markets, risk is relatively cheap. Prices are low. So you can take risk during those times. During bull markets, when risk is very highly priced, it's not very good to buy it then, right? So you want to buy risk when it's cheap and sell it when it's expensive if you're trading, right? And so with altcoins, they tend to outperform during the latter stage of a bull market. That's good if you're in a bear market or if you're looking ahead. You can make trades now, wait for that bull market to come. You should make some profits. Of course, if you're in a bull market and altcoins are doing really well, the next phase would usually be the drawdown phase, the bear market, where altcoins are going to get completely wrecked. So what most beginners do is they come in during the bull market, put all of their money in, get completely wrecked and leave. So they're never going to make any money. So we need to make sure that we understand cycles happen in these 4-year periods. We always need to look ahead 12 to 18 months and make trades now for that time. And also understand that really bear markets are the time to be the most active when, ironically, most amateurs leave. So if you want to be more professional and actually make money, We have to understand these cycles, be active during bear markets. Understanding these cycles and how to play them is a massive hurdle if you are a beginner. I do go over this in the crypto course. I'll link this down below. 300 videos here on, getting yourself set up in crypto. But down at the bottom, I update it for free with my research on the cycles as they're playing out and what's happening. So I highly suggest having a look, because the research comes for free for existing users there. And it's basically my experience of what's happening with the cycles. You can see it play out and the decisions and all of the on-chain data and everything like that. So I'll leave this link down below if you're interested. Something also very important if you're looking to trade crypto as well or invest in crypto. So cycles are important, which I'll go through in a second so you can identify these so that we can take advantage. But also it's important to understand how altcoins work specifically, because this doesn't apply to Bitcoin, which we know the supply schedule for BTC. It's basically all in existence at this point. So go to CoinGecko, go to Customize, go to FDV and Market Cap FDV. Turn both of these on. FDV is fully diluted valuation. Most cryptocurrencies, so let's take out Bitcoin now. So we're looking at altcoins. Altcoins are projects started by human beings, not weird Satoshi Nakamoto kind of, So humans, they're starting a project. They're trying to serve customers, right? So what do they need? They need money. They need dollars in actual money to pay for development, to pay for employees, etc. The way they get that money is by selling tokens of their project. So investors put actual money into the project gives them tokens, and those tokens are supposed to represent the project itself, earning money from their customers, and then returning money back into the token to those investors. So that sounds a lot like an equity investment, because I think it is. Now, there's a lot of regulation that still has to come out, so we're not going to get into that. But essentially, a project will have an amount of tokens when they launch, and there is an amount that trades, and there is an amount that is left to unlock over time, because they can't just dump the whole thing on the market at once. They essentially have what's known as a vesting schedule. So when they list, maybe 10% of the tokens are what's known as floating, available to trade. As much as 90% are locked up and vest over maybe 3 to 5 years. The reason why that's important is because this affects crypto prices during the short term and the long term. So let's go through this. You can see FDV here. This is the fully diluted market cap, meaning you take the price per coin and you multiply it by the total amount of coins that can exist now and in the future. And so fully diluted is really what we should be looking at, because that's the price of the project that we're trading and the value of the project that we're actually trading. And so let's have a look at this. Market cap FDV, right? Bitcoin is 0.94, so 94% of the tokens are in existence. Ethereum, 100% of the tokens are in existence. Same for BNB. For Solana, it's 78%. For XRP, it's only 55%. Down here, we can see. So there's two effects of this. The first one is, if you have a crypto coin with a tiny, tiny float of coins, you have very, very few coins that are in existence to trade. That coin can be extremely volatile in price, because you have the whole world looking at crypto available to trade it, and you have a tiny amount of coins that can trade. That means that a small amount of volume can very heavily influence the price over the short term. That is why smaller coins can move so much. They're much smaller, and so smaller amounts of capital can move them, but also the liquidity is so tight. The amount of coins that can actually trade is so tight that a small order can move the price a lot. Now, that is both an upside and a downside. So during a bull market, during, these, you can see crypto prices during bull markets when money is flowing into crypto. These altcoin prices can explode because they have a tiny amount of coins that are available to trade and a lot of people rushing in at once, right? So what happens? Price goes up a lot. So that's what we can trade. So if we're looking ahead, trade these things to the downside, because in a bear market, it's the exact opposite. Tiny amount of coins, everyone's trying to sell, huge dump in the price. Can go down like 18, 90, 99%. So during bear markets, we know that if that happened, maybe looking forward to 12 to 18 months, maybe that's something that we can trade. So the other thing is, that's the short term. The other thing is the long term, is that if you're trying to invest in these projects over the long term, then you just have to be aware that essentially there's a lot of money and a lot of tokens that are just going to be sold and dumped on your head over the long term. Because these projects, these investors, these early investors who took a risk with their money, put their money in, and they're vesting these tokens over 3-5 years, getting the money back, what are they going to be doing with it? They're going to be dumping it on the market. That's important because if we scroll down, you can see there are many good projects that I think are good projects that have huge fully diluted valuations. You can see these two here, some of the top projects in the space. The market cap is around 2.7 billion for both of them, and the fully diluted is around 10 to 11 billion, right? So only 25% of the tokens are in existence. During bull markets, that can be very bullish. Small amount of tokens, buyers coming in, push the price right up. However, if you're investing, you have to know that 70-80% of the tokens are still to be sold, right? That's a big seller in the market that you're fighting against, buying those tokens and holding them, right? So even though it's a good project, it's still going to get wrecked because all of these tokens have to come onto the market. Another thing to think about is when we look at things like this, all of this data shows the market cap of altcoins and Bitcoin. The market cap, the market capitalization, not the price of those coins. If we go over here, what happens when you sell coins into the market? Price goes down. But if buyers are coming in, buying that, they push the price back up. The problem is when you have all of these tokens that still have to be sold into the market, that means that the actual market cap can go up because remember, this is fully diluted at 10 billion. This is the market cap that all of this data is showing right now at 2.7. If these tokens here get sold and buyers come in, right, the market cap can go up, but the price stays the same because you have more tokens in circulation, right, which pushes the market cap up. And maybe buyers are coming in and buying all of them. So market cap up, price stays the same. So when you're looking at this and you're saying, well, the market cap, look at this is total crypto market cap. Yeah, the market cap can go up, but the price of the token may not necessarily go up. We have to make money from the price of the token. We can't trade the market cap. Right? The market cap, because of the fully diluted valuation, more tokens in existence can go up, but the price may stay the same. We're trading the price. So that's important to know. So what we should really do is actually look at altcoins or any investment in price versus the two majors, which is Bitcoin and ETH. So what we can do is price altcoins valued in those and not look at their market cap and not look at the price versus dollars either. So now we'll come on to, I think a big unlock for a lot of beginners is to not value coins at all in dollars or your fiat currency, but to value them in Bitcoin. The very first section was the CAGR of Bitcoin, 50-60%. So that's the hurdle rate. Because if we're investing in crypto, Bitcoin is the major asset, the large, reliable, institutional grade asset. That 50% a year is the hurdle rate for any other investment. If we're taking more risk in altcoins, we have to outperform that yearly 50% hurdle rate. We can do over the short term. You've seen that towards the tail end of a bull market, altcoins can outperform. But if you're an investor, altcoins tend to have a lot of supply. They may not outperform over the long term. In any case, all we have to do is look at the price versus Bitcoin to see how these altcoins react. So this is total market cap of altcoins, excluding Bitcoin, ETH, and stablecoins. So again, it's moving up, right? So there's no issues here. Right, investing in the altcoin market seems to be pretty good. But like I said, if most of the coins have not been in circulation yet, like this, right? If you go down, you can see altcoins. 25% of the coins are in circulation, right? Only 70%, 20%, 25%, 30%. That is a heck of a load of coins left to dump on the market, which has to be absorbed by buyers just to keep the price where it is. So looking at the market cap of the altcoin industry, isn't good to look at. It's not good data because the market cap can go up, but the price can stay the same, meaning you're underperforming BTC. So what I would suggest is when looking for any altcoin to actually chart the price versus Bitcoin and not dollars. Because yeah, dollars, the base investments should go up versus dollars, but really you're in crypto, so Bitcoin is the reference rate at 50% CAGR. So what you can do is go to your trading system. Now I'm using TradingView here. TradingView is free. It's great. I recommend it. So I'll link them below. There is a paid version, which I have, and I would actually recommend as well. It's brilliant and worth it. But if you don't want to pay, just use a free version and value all of your coins in BTC or ETH. Now, a lot of altcoins you may want to value in ETH because that's kind of the reference rate for altcoins, but it's up to you. So for right here, there's no point looking at Ethereum versus dollars. You have to look at Ethereum outperforming or underperforming Bitcoin, right, as the reference rate. So this is the chart of Ethereum versus BTC. And you can see that we are in an uptrend, a bit of weakness here, but generally there's been an uptrend as Ethereum was launched after Bitcoin. It was very new and clearly gained adoption. However, the uptrend is slowing down a lot as the assets mature, right? So you can see that, yes, it did outperform, but that outperformance is kind of slowing down a little bit now. If we go to some other coins, you can do this for any coin, right? So don't look at the coin versus dollars, but I'm looking at Uniswap. So the Uniswap token versus Bitcoin, right? Down only, right? So a terrible investment versus BTC, even though the market cap may have gone up because of the token supply increasing over time, the price is what we have to trade. And that was not a good investment versus BTC at any point. You can also see Dogecoin here, right? So a massive outperformance versus Bitcoin during the last bull market. You know, you may get that again. However, in general terms, it doesn't really look very bullish to the chart, right? I mean, it's kind of down sideways, right? Not really going anywhere, right? You had the outperformance and then it got sold off again. This isn't a bullish looking chart. So again, the crypto market cap can go up because Dogecoin has an unlimited supply, around 2% inflation. So over time it matters. So the market cap can go up. So if you're looking at total crypto market cap, yes, that can go up, but it's not relevant to us. We need to look at the outperformance versus BTC as the reference rate. Now let's look at Bitcoin and crypto cycles because these cycles are the opportunity. So the opportunity is in a bear market, right? When prices are high, that's not the opportunity. Buying something when the price is high is unfortunate. Most people get in during the top of a bull market because they want to make money. They see the price going up, but they have obviously no experience of economic cycles and how the market moves in price cycles. So to become more professional and to actually make returns, we have to be confident in the assets that we're buying, and we have to be confident enough to buy them when prices are low. And that's the sweet spot. The sweet spot of investing is identifying assets with secular long-term growth and then buying them when prices are low. That's the sweet spot because you're getting the best stuff for cheaper prices. That's how we try to accumulate wealth. So there's two things here. The first one is Bitcoin and crypto, they have secular growth, right? So their growth rate is, like we've seen, 50 to 80% a year. If you just want to outperform everyone else, just buy, wait. That's it. 50 to 80% a year. Buying the very top of every bull market, buying the bottom, everything in between. You're going to outperform every hedge fund, every pension fund, every 2 and 20 hedge fund that's, charging. You're going to outperform everyone just by doing that, right? Hedge funds don't make that much and they charge you so much in fees that whatever they make, they take anyway. Bitcoin and crypto, you can actually buy it and hold it for nothing. That's a big thing. In any case, the sweet spot is to buy assets that you're confident in when the price is low. Of course, during bull markets, we see these big percentage gains for altcoins, right? But the problem is no one actually makes money from that because they're not confident in the bear market to buy it, because actually that thing's kind of like a bad idea, or, maybe it launches in the bear market, you don't really know. It's not a long-term investment strategy, really, apart from that trading percent in your portfolio to say, I'm not really confident in these things, but they may move during a bull market, so I can trade those, and if I lose, that's fine. But for the bulk of a portfolio, we need to have those assets that we're confident that have secular long-term growth. What's an example of that? The tech industry, right? FANG, Apple, Microsoft, Nvidia. Okay, that's a secular growth industry. It's going to continue to have growth. So whenever the price comes off in a cyclical low, you go in. And so the way that we can see this in crypto is very, very clearly through on-chain analytics. So I've got a big section of this in the crypto course that teaches you what these are and how to identify them and use them. I also do my research, right? My updates showing you what I think about this. But essentially the sweet spot is secular growth, those low price cycles. They're the sweet spot. This is unfortunate up here. If you're a long-term investor, it doesn't matter. Like I've said, 50 to 80% a year outperforms everything else anyway, right? But if you are looking to be more active, then the sweet spot, you have to be active there. It's the only way to outperform is to buy when things are lower. So long-term secular growth assets in price cycles where the price falls, we get very, very active and buy. When prices are very high, if you're a more active trader, you want to take profits, you can do it then. And if you don't need to sell, then don't, right? Because this asset still has so much secular growth. We're so far away from this being mature, right, that taking profits is crazy. If you know that this asset class is outperforming everything else, why would you sell it? What are you selling it for? If you want to take profits, if you want to improve your lifestyle, great. But, you don't just sell to take profits unless you're trying to speculate a little bit. But like I said, that should be a smaller part of the portfolio because this is the outperformance. So this is MVRV. Look into Bitcoin as a free site. I'll link them below. Very simply, I'm going to take everything away except for MVRV. So essentially, when MVRV is way down, you're seeing that the price is relatively very low. So you should buy that. If you believe in the secular long-term growth of the asset, this is Bitcoin, so I do. So when price is low, when MVRV is showing us that it's very, very low down here, it's a massive buy zone. Buy there, these 4 massive cycles, you can see that each time. Very clear that when you're in the green zone, that's the ultimate buying opportunity. Again, when MVRV is very high, that signals a massive bull market when prices are relatively high. So again, if you're trading, these are areas to sell, of course. And you can see that very clearly, right? So MVRV is really showing us the relative price difference. Is it overbought? Is it oversold? What's happening? Very, very clear to see. When you put the market cap back on, you can see that it lines up perfectly with these bull markets where the price rises a lot. When the bear markets come down and the price, falls, you can see MVRV here. So perfect indicator to show you when the price is very high or very low relatively. If you trade, you have to look at this stuff. You have to take positions in bear markets and think 12 to 18 months ahead. If you're buying when prices are very high, you don't know what the price is, right? Is 70K a good price for Bitcoin? Is 120K? I mean, who knows, right? Just look at MVRV, look at the cycles. Eventually, if the MVRV is very high, the bull market is very, very mature, the next phase, what's the next phase going to be? It's not another rip-roaring bull market, is it? Because think of the participants, right? You have very long-term investors who don't care, never going to sell anyway, right? Certainly not in the next 10 years. And then you have traders who eventually are going to be making so many profits, and eventually the market cycle is going to turn. They're like, okay, we're done now. So the next phase, right? So cycles are incredibly important for traders and investors. Long-term assets, be very active when the prices are low. And if you're long-term, just buy them all. But if you're trying to outperform a little bit, buy more here when prices are low, or when the MVRV is low, and either don't buy or buy less when prices are higher and MVRV is higher. You can see very, very clear cycles with Bitcoin. Away from on-chain analysis, we can also look at technical analysis, which is just price data. So the simplest thing here is to look at the moving average of the price. This smooths out any short-term price moves. A 200-week moving average takes the price each 200 weeks and moves that average 1 week each week up, and then you eventually get this smoothed out line. So again, if we take away the price chart, what we're looking at, that is your portfolio, right? If you're investing in assets with secular growth, what you're doing is investing each week or each month, whatever you want to do. So the daily price of Bitcoin or crypto, whatever you're investing in, If you're investing for long time frames, at least one cycle, 4 years, ideally at least 2 cycles, which is 8 years, your price for the asset becomes the average price for the market. That's fine. We're not looking really to outperform 50 to 80% yearly returns. Those returns are the outperformance. Just deciding to buy this is the outperformance versus the stock market, which goes up 10 to 15% or has done in the last decade. So don't worry about the price if you're investing in secular growth assets. Think about the averaged price over time, which is this. If your portfolio looked like that over time, you're doing pretty well. And it's very simple. You don't have to spend too long. You don't have to stare at the screen all day, right? You don't have to make wins and losses and everything, just this. If your portfolio looked like that over time, you'd be, wow, great trader. All you have to do is dollar cost average the asset that with outperformance and with secular growth. So this moving average, that is your portfolio and not the price itself. The other thing we can see is that Bitcoin, when the market price, the daily traded price, comes into this 200-week moving average, is a massive buy zone. So along with MVRV, which shows us this as well, which is on chain, you can just look at technicals and say, well, this price is in an uptrend very clearly. When the price does fall down, that's the best opportunity because 12 to 18 months after that, the uptrend may continue again, right? So as you can see, each time the price goes underneath this 200-week moving average, a massive opportunity. That's when you're going to make the most amount of wealth and money from investing in an asset with secular growth, right? Is when its price is pretty low. You can, in relation to its trend, you can go over to TradingView again. So choose the asset and then go over to indicators. And you just have to type in simple moving average here, or moving average simple, I think they have it as. It's this one. And then in the settings, just make sure that you're on whatever time frame that you want. Longer time frames are best for this, but shorter time frames, you can look at. I have a 200-day moving average here, right? And you can see the white line here, right? So if your portfolio looks like that over time, pretty good. As you can see, as the price falls underneath this, these are opportunities. So we don't have to get too cute with trading or trying to make money. The outperformance comes from identifying the strong assets that we can invest in. And also, if you want to be more active and genuinely outperform that, then you have to be patient. You have to think in longer time frames, like 12 to 18 months. When prices are relatively low in relation to trends, that's when you go in more with either your investment stack or your trading stack. So you take risk when risk is cheap. Don't take risk when it's expensive. I'll also show you some other data on cycles as well, because for most beginners, I understand the temptation to go and day trade. You want to, you want hand-to-hand combat. You want the excitement of that. That's a strategy, brilliant. For most beginners, considering that maybe you are a beginner and so going up against the market is probably a bad idea, right? Playing 18 holes of golf when you picked up a club for the first time, you're not going to score a very good score. You probably have to go and approach it a little bit differently. The individual cannot compete against the market. It's almost impossible. You have professional firms with hundreds of millions of dollars behind them, right? These trading systems, short-term market makers coming in with, intra-second trading. How are you going to outperform that? We can't. We have our outperformance through our patience and our long-term thinking, because day traders are going to get completely ripped up by professional firms, but we can have outperformance through patience and determination over longer periods. So if you're looking to trade cycles, I think 12 to 18 months at least for a trade to make sure that we take risk when prices are lower, right? And see what happens in the next kind of wave forward. And then if you are looking to take risk, understanding that during the peak is the worst time. So this is the liquidity cycle. It's a central bank liquidity cycle. Central banks do control these cycles. And you can see that Bitcoin pretty much perfectly aligns with these cycles. I talk about this a lot more in the crypto course and update this because this is obviously very important. This is kind of how cycles, come about, is central banks manipulating money supply and interest rates. So you can see when the cycles are, at their low ebb. That's when Bitcoin tends to be at its low. And as the liquidity cycle moves and actually more liquidity is pumped into markets to actually move them forward and prices higher, prices go up, prices react. So as long as we know this, we can time it. If you're coming in a bull market and you're wanting to make money, well, unfortunately the market doesn't care what you want to do. If you're trading long at the top of a bull market, the next phase is to a down move, you're going to get wrecked. So you have to have patience. If you want to trade, you have to actually time it and know what part of the cycle that you're in. And like I said, investing kind of doesn't matter too much because the asset class is outperforming. You can see the liquidity signal here, major central bank balance sheets. It lines up perfectly with the market. So we can actually look, Tech Dev, I'll link below. Great research here showing exactly how these cycles are playing out. So use this for your trading, right? If you're looking to take risk or you're looking to take a position, understand where you are in the cycle. In the next 12 to 18 months, is the liquidity cycle going to move in your favor or not? Because if you're trading against central banks who control everything, you're going to get wrecked. If you're taking a long position at the wrong time, you're going to get wrecked. So rather than looking at technical analysis and moving out, let's just look at the large cycles that we can play and have patience, and then we can actually outperform. Again here, drawdowns are very important. Actually, the only way to make money, right, is actually buying drawdowns. How much are they when they draw down, right? What does Bitcoin draw down? So usually 30-odd%. These are bull market corrections. So within bull markets, the price can go down 20, 30% regularly. You can see all of these drawdowns. So I would suggest that if you are looking to accumulate assets that have secular growth, you're looking to buy during bear markets, you can see where those bear markets may happen. They're where you get the big drawdowns, right? 60 to 70% drawdowns. During bull markets, if you're looking to take a bit of risk or you're looking to trade, you kind of have to wait for these drawdowns. And then you can get in, buy some, right? If it draws down 20%, buy some, 25%, 30%, buy some. Because you're in a bull market, the liquidity cycle shows you that. And those drawdowns are the opportunity to buy lower prices. And then during a bull market, you should expect the price to actually rise during that bull market. So I'm trying to get across is that really we need to buy low. And buying low means buying pain when everyone else is upset and angry and selling and not interested, and when things die down a bit. That's when amateurs leave. The professionals still there, right? Professionals practice all day in the sideways rain, right? That's what makes them professional, right? There are many people with talent, but only the pros are the ones that stick around when it's raining sideways, right? That's the market. If you want to actually make returns and outperform most other people, all you have to do is understand that pain is your friend. Drawdowns are good in bear markets and in bull markets. Now we can look at putting some orders into our trading system to make trades when we want. So the first thing we need to do is understand, are we in a buy zone? Do we want to buy? At the top of a bull market, not the best time to buy, but if you're a long-term investor and you're dollar cost averaging, no problem. If you're looking to be more active, then you have to buy during those opportunities. In any case, for something like BTC, it has secular growth, and then you can very easily plot that over time. So this is Pantera. I'll link this below as well, but each expansion cycle that you can see, it essentially is actually getting lower in returns each time, right? So that's fine. We know that. So if the secular growth continues and the adoption continues, which all the fundamental data is showing, then you could just say, well, this cycle is going to grow, but not as much as the previous cycles. You can put a fairly decent figure on where the price may get to. They say around 100K. Okay, so around 100K. That's the price where we may get to. So in the back of your mind, if you think it may get to around that, then you can make very easy decisions on what you want to do. Do you want to take risk or do you not want to take risk? Right? So that would be a price level or a price target is 100K. So at what point do you, if you're trading, not want to take risk as much, right? Draw the rectangle or the box here and say, if I'm trading for the short term, buying up here is probably not a good idea. If I think it's going to get to 100K and the cycle will play out, then anything like under this level is, still take risk, be patient and wait for the, price to appreciate because the asset has secular growth. Simple as that. So that would be a potential zone where you either sell if you're looking to take profits, don't buy as much, if you're looking to try and outperform, or if you're a long-term investor, keep buying because it's going up 50 to 80% a year anyway. That's up to the individual. From here, I'll show you to go ahead with a trade. So I've got specific video guides for all of the exchanges down below. If you want to know how to get set up with an account, get fiat currency in there, how to swap it into stable coins and trade out, and a lot more technical analysis, I'll leave all of those videos below. For here, I've got some money in my Bybit account, so we'll go ahead and buy. So a spot, we want to trade, spot trading, right? And I'm just going to buy some BTC, spot, and we have a buy right here. So what should you use, a limit or a market order? A market order is when you do not choose the price that you trade. You just take the asset that you have. If it's your fiat currency or a stable coin, you sell that and you buy the crypto asset. So market order is that. We're going to use a limit order, which is where you choose the price that you trade at. So the order price I can choose, and I can choose the amount that I'm buying. So let's choose an order price of 60K. And I want to trade this amount of BTC. So that's the slider here. You can see the trading pair that I'm trading is USDT BTC. So I'm selling USDT and I'm buying BTC. 60,000 I want to trade at. So because it's a limit order, this means that I choose the limit at which I want to trade at. 60,000 is the price that I want to trade at. So either 60 or below, the system's going to trade for me, right? So I want to buy this amount of BTC right here. I'm going to press buy BTC and then confirm that. Now what you'll see is that my order is actually down here in current orders. So it shows the details right here. You'll also notice that I actually haven't traded because it's not in trade history. It's a current order. It's an open order. So I've given the system an instruction to buy Bitcoin at 60K. Well, that's great, but the market is higher than that. The market is 61,574, meaning that my order is too low. So what will happen here is that my order stays in the system. It comes onto this order book right here, and it's actually down here at 60,000. Now, if the market falls and there are sellers that come in that want to sell at 60K, I'll be waiting at 60 and I can buy it at 60. But my limit is 60,000, so I can't trade because buyers are way higher than me and willing to buy at higher prices. So the order will be here and it will sit in there. Now this order price here, you can edit this. So let's edit and I can do 61,000, right? And so I can press OK. So that edits the order, but still my order is too low, so it won't trade for me, right? So what we can go ahead and do is just cancel that order out. And then that will cancel the order, so that order's gone. So I've not traded anything because my limit price was too low. Now, if I put a limit price here of 70,000, right, and buy the same amount of BTC, all right, what's going to happen? Well, my order now kind of isn't a limit order anymore. It's a market order. Because what I'm saying is buy right now, immediately, as long as the price is underneath 70,000. And of course it is, so it's going to buy immediately for me. Well, that's fine. But obviously, you know, it's just a market order at that point. So a tip here, if you are buying BTC, is to look at the current price, 61,574, right? And then do something a little bit lower than that. Because what you'll see is that the price jumps around, you know, $10, $20, $30 kind of regularly, right? And so what you can do is try and get the cheapest price possible. Now, if you put a limit order in and the price is going up, obviously you're not going to trade. But you can use a limit order as you want. So 61,538, we'll put that order in. And again, that will not execute because we're lower. However, the price may jump around for us. So what I'll show you is actually how an order is executed. So market, I'll choose $100 here to put in, or any amount, right? Buy. And this is a market order, so it'll go through immediately. Up at the top, you can see your order was filled and that went through. So that's not in current orders, it's in trade history. And that's the same for every other exchange as well. You may also want to use a stop loss order if you are trading with specific trade ideas, but investors don't use stop losses. So investors are taking money that they have no use for and buying assets that outperform the fiat currency. And they're just buying that over the long term and they stomach the volatility over time. If you have a trade idea, which is much more uncertain, you don't want to get completely wrecked in a trade, a stop loss is an order to sell out your trade at a loss to prevent further losses. So we can use that on most systems. Bybit has it, Binance has it, OKX. Stop loss, you can see here, TPSL. So it will be known as a stop order or a stop loss order, or TPSL, which is take profit stop loss. It's the same order type. Now, take profit is when you set the order above. Stop loss is when you set the order below. So what you have to put in here is we're going to sell, okay, with a stop loss. Because what we're doing is selling out of our risk asset. So you're going long, right? So you're buying an asset that you think goes up in price. Obviously, if the price goes down, maybe you want to stop yourself out at 20% loss because you don't want things going down. You don't want like a 50% loss. So like I said, investors don't do this. But if you have a specific trade idea and you think in 12 to 18 months, this asset will be higher, but I'm not sure. And to be honest, I don't want to sit on it because I don't want to invest in this. It's kind of a trade. We take a stop loss. So what we do is sell. So I've got some BTC that I just bought. So that was the trade. And I know that I think this cycle will be up here and I want to trade here, but I don't want to sit on a huge loss. I don't want to sit through a bear market. So I'll take that stop loss. So trigger price and then the order price. So this type of order is known as a trigger order or a stop order, which is where you tell the system at what price to then enter your trade. Now, the reason we have to use this is because with a limit order, what you're saying is trade immediately right now, as long as the price is better than my limit. Now, that isn't going to work for a stop loss because what we're doing with a stop loss is saying if the price goes down to 50, sell. With a limit order, if I said my limit order was 50,000, so if I put a limit order at 50,000, right, and press sell, the system would sell immediately because the price is 61,000 now. So it's saying, yeah, sure, your limit order is 50. I'll just sell at the better price. But we don't want to do that. We actually want to wait for the loss to occur to then sell if we're using a stop loss order. So we need to use that trigger. The trigger is the price at which the order down here is actually put into the system. That prevents us trading until the price gets to a level where we want to trade. So the trigger price is 50K. The order price, we'll just use a market order to make it simple. What you're saying is at 50,000, enter a market order to sell my Bitcoin, sell BTC. What this is going to do is not sell my BTC right now because it's not a limit order. So my trigger price is 50, market order, going to sell some BTC like this, sell BTC. And what you should see is that it's in a current order. See TPSL order, it's right here. So if this was a limit order, I would have sold, but it's not. It's untriggered because the 50,000 trigger price hasn't been met yet. That is how you put a stop loss in. So you can buy at 60 and sell for a loss at 50, but it prevents any potential further losses. I don't use these for investing at all. Investors do not use stop losses. But if you have more specific trade ideas and you don't want to get caught on the wrong side of something, then that's what stop losses are for. So the data that we've seen in this video shows us that prices do move in cycles, but then the secular growth is very clear. So when prices are low during bear markets or bull market drawdowns, they are opportunities to buy assets that have genuine long-term growth. We've also seen that altcoins can outperform Bitcoin over short-term time horizons, so you can use that as an opportunity to maybe try to trade and get higher returns than just investing in BTC and ETH. But those are going up at 50 to 100% a year, which is pretty good returns, to be honest, right? If any hedge fund had that return, it'd be like the top performing hedge fund. In any case, that Bitcoin is the largest or the best performing large scale asset. And so you may not need to trade. You may just need to allocate to the growth asset class. For me personally, if you have a large portfolio, you don't need to trade, right? If you can get a portfolio that's large, which means a lot of time and effort, because guess what? You're not going to make millions trading meme coins, right, in your spare time. Let's be real. So gaining wealth is a long-term effort-driven exercise. It's going to take a lot of effort, concentration, determination. If you can get a big enough portfolio, you don't need to trade. Bitcoin is going up at 150% annualized. That's coming down. The CAGR is coming down. Even this year, as of making this video, it's up 50%. So if you had $100,000 in there, you're up $50,000. You never even traded once. You never did anything. You're touching grass, you're playing with your kids, you're with your family. You don't need to trade. You just need to understand where the outperformance is and regularly get into it. We must invest during bear markets. We must invest there because that's where the returns are. The returns are where you buy the lowest price. The returns come in the bear market when you're allocating, not in the bull market. When you're buying in the bull market, you're getting the worst returns. You have to think the complete opposite of what amateurs are doing, which is getting in the bull market, buying at those high prices. It's better for beginners to think about asset allocation bundles rather than specific projects, in my opinion. As you get more advanced, you can go deeper and try and get outperformance versus BTC, as you can see with the cycles and the altcoins outperforming during those specific periods. But generally, look at this, screenshot this. These are the asset classes that are investable, the large asset classes: US stocks, US tech stocks, property, gold, Bitcoin, some bonds. You can see which ones outperform. It's very clear. These are the asset classes. Just think of that. Bitcoin is an asset class. Crypto is an asset class. And then these other ones. What do you want to do? What mix do you want? That's up to you. That is the easiest way to start allocating to risk assets without having to look at all of these individual projects and taking all this time in projects that ultimately, 90+% of them fail anyway. So, make it easy for yourself. Grow a large portfolio, large enough where you don't even have to trade. You can just let this performance speak for itself. All of the links to the exchanges I mentioned, the crypto course, Twitter posts, and everything else linked down in the description below. I'm James, this is MazzyG. Cheers for watching, and I'll see you in the next one.